Huge news coming out of Fed. If you own gold and silver, watch now. Peter Schiff just dropped a bombshell. The Federal Reserve's latest move isn't what it seems. And if you're holding precious metals right now, you need to hear this immediately, because what's happening behind closed doors could change everything for gold and silver owners in the next few weeks. The institutions know something. The mainstream media won't tell you. And by the time this gets out, it might already be too late to position yourself. What Peter revealed will shock you to your core. Welcome to Currency Archive, where we bring you the financial truths that matter most. If you're a serious investor, someone who values their hard-earned wealth, and you're over 50 building your legacy, then you're in exactly the right place. Do me a favor, hit that subscribe button right now, because the information we share here could be the difference between protecting your retirement and watching it vanish. And tell me, where are you watching from today? Drop your location in the comments. I'd love to know where our community of serious investors is tuning in from around the world. Now, let's get into what Peter Schiff just revealed. The precious metals market is entering a phase that few investors truly understand. What appears to be just another bull run is actually something far more significant. The forces driving gold and silver higher in 2026 are not temporary. They are structural shifts that have been building for years. Peter Schiff, a macroeconomist who has spent decades studying monetary policy and currency cycles, sees three major forces at work: de-dollarization, persistent inflation, and an increasingly accommodative Federal Reserve. These are not predictions about the future. These are realities unfolding right now. He points to historical data that tells a clear story. During previous easing cycles, when the Federal Reserve loosened monetary policy, gold delivered substantial returns. Real interest rates turned negative. Confidence in paper currencies weakened, and precious metals moved sharply higher, often before the broader market even realized what was happening. But this time, something else is occurring simultaneously. Global central banks are accumulating gold at near record levels. They are not doing this quietly. They are doing it openly. And they are doing it for a reason. They see what is coming. At the same time, the United States continues to run massive deficits. Debt servicing costs are rising. And the Federal Reserve, despite all the talk about fighting inflation, continues to inject liquidity into the system. History shows that repeated liquidity injections trigger sharp moves in precious metals, particularly during weekend gaps when Asian markets open. Schiff makes a critical point. Waiting for confirmation in this environment often means paying higher prices. Inflationary policies do not reprice gold and silver gradually. They reprice them rapidly, and when that repricing happens, it happens fast. He encourages investors not to wait until Monday to make their moves. Buy on Friday night, buy on Saturday morning, buy on Sunday morning. Buy any time before Asia opens for trading on Sunday night. Because when those markets open, gold and silver can gap higher. And by the time Monday morning arrives in the West, the opportunity may already be gone. This is not just theory. This is what has been happening repeatedly. Investors who wait for the perfect entry point often find themselves chasing prices that have already moved significantly higher. When it comes to gold, Schiff sees very limited downside risk at current levels. He does not believe gold will fall below $4,300. With gold trading around $4,500, the downside appears minimal. The risk-reward ratio strongly favors buyers at these levels. Silver, however, tells an even more compelling story. The volatility in silver is much greater, which makes sense given the magnitude of the breakout. Silver blew through $50 and barely paused. Schiff had been forecasting that once silver broke above $50, it would become a moonshot, and that $50 would act as support. For a brief period, $50 did act as support, but the market moved so aggressively that support quickly shifted higher. Schiff now believes that $70 is the real support level. He does not think silver will go back down to $50. That opportunity is gone, and he hopes that many investors took advantage of it while it was available. Throughout the previous year, he repeatedly told people to buy silver at $30. Then he said, buy at $40, then $50. Now he's telling people to buy at $70 if they get the opportunity. After silver climbed above $83, the low of the pullback was just above $70. Ever since silver got above $80, it has never been below $70, although it has tested that level. The real support zone, according to Schiff, is somewhere between $71 and $75. That is probably the best place to buy it. But here's the problem. He would not wait for $71 or $72. He would buy it at $79. And the reason is critical for long-term silver buyers to understand. For people who want physical silver, not paper contracts traded on the COMEX, but actual silver delivered to their home, the situation is becoming urgent. There are two things that are going to happen in 2026. The price of silver is going to go up, but also the premium on silver products is going to soar. The premium is what buyers have to pay above the spot price to actually acquire a 1-ounce coin or a bar, and that premium is expected to increase dramatically. The silver market is facing a supply crisis that most investors are completely unaware of. While traders focus on spot prices and chart patterns, a far more serious problem is developing beneath the surface. Physical silver is becoming harder to obtain, and the situation is about to get much worse. The reason is simple. There is not enough physical silver being mined to meet the demand that is coming. Production has been constrained for years due to underinvestment in mining capacity. Exploration budgets were slashed, development projects were delayed, and now as demand surges, the supply simply is not there. China has already implemented an embargo. They are not exporting any silver. And China happens to be the world's largest silver producer. This alone creates a massive supply deficit. But the problem does not stop there. Investors around the world are finally waking up to what is happening with silver. They are beginning to understand the shortage, and they want to own physical metal. This creates a dangerous situation for anyone waiting to buy. Even if silver pulls back to $71 or $72, the premium that buyers must pay on actual products may have widened so much that the total cost is actually higher than buying at $79 or $80 today. The spread between spot price and retail price is going to expand dramatically. Schiff believes that later in the year, dealers will simply be out of stock. Investors will want to buy physical silver, but it will not be available to deliver. That is going to be the problem. Or perhaps dealers will still have some inventory, but delivery times will stretch out for weeks or even months. Right now, supply is available. Premiums have not yet increased significantly, but that window is closing rapidly. For investors who do not need physical delivery immediately, there are alternatives. Schiff mentions the T-Gold platform, which is part of Schiff Gold's storage program. This allows investors to buy gold and silver without taking immediate delivery. The metal is stored securely, and eventually this platform will expand into an e-commerce system where tokenized gold and silver can be purchased and delivered. But for investors who want metal in their own possession, for long-term storage and self-custody, the message is clear. Buy now. Do not worry about whether silver is at $79 or $80. Just be glad that it is still available because silver is going to become very scarce very soon, and the price will likely be much higher. This is not just a precious metals story. The entire commodity complex is moving higher. Copper broke above $6 this week for the first time ever. Nickel is rising, zinc is rising, lead is rising, prices are going up across the board. And it is not just going to be metals. Agricultural commodities are expected to boom as well. Eventually, oil will join the rally. It has held at lower levels longer than many expected, but even with developments in Venezuela and other supply disruptions, oil appears to be bottoming. The technical picture is improving, and the fundamental backdrop supports higher prices. This is an inflation-fueled commodity bull market, but it is also being driven by supply shortages caused by decades of underinvestment. Capacity was not expanded, exploration was not funded, development projects were not pursued, and now the world is facing shortages across multiple commodity categories simultaneously. It is a perfect storm for investors who are long precious metals, but it is a disaster for anyone who needs to buy them, and it will be catastrophic for industries that depend on these materials for production. Right now, investors need to take advantage of the fact that prices are still nowhere near where they're going, and supply is still available. Gold and silver mining stocks, despite their strong performance last year, are still incredibly cheap. Some analysts believe that this year could be even better than last year. That is how undervalued these stocks remain. The mining sector is positioned to not only catch up with the gains in metal prices, but to surpass them. Just as silver caught up and surpassed gold in performance during the previous year, junior mining stocks are expected to catch up and surpass the senior producers in the coming year. The true juniors, not the mid-tier companies, but the small exploration and development companies, are where the real leverage exists. The junior mining sector represents one of the most asymmetric opportunities in the current market environment. While senior producers and mid-tier companies have participated in the rally, the smallest companies have barely moved. These are not the stocks in the GDXJ index. These are the real juniors, the little guys. And they have not experienced anywhere near the gains that should have occurred given the explosive move in metal prices. But everything is about to change. The pattern is repeating itself exactly as it has in previous bull markets. Silver caught up to gold and then surpassed it in performance. The same dynamic is now setting up between junior miners and senior producers. The juniors are going to catch up, and then they are going to surpass the big stocks. For investors seeking maximum leverage to the precious metals bull market, this is where attention needs to focus. Schiff manages the Europe Pacific Gold Fund, ticker symbol EPGIX, which is specifically positioned to capture this move. The fund maintains significant weighting in junior mining stocks. For larger investors, separately managed accounts are also available through Europac Asset Management, with customized exposure to these smaller mining companies. But the real question is, what will power this next phase of the bull market? Three forces are aligning that will drive precious metals substantially higher throughout the year: de-dollarization, inflation, and a highly accommodative Federal Reserve. The dollar's role as the world's reserve currency is under assault from multiple directions. countries are diversifying away from dollar reserves. They are conducting trade in alternative currencies. And they are stockpiling gold as a neutral reserve asset that cannot be weaponized or frozen. This trend is accelerating, not slowing down. Inflation remains persistent despite all the official rhetoric about bringing it under control. The policies being implemented are inherently inflationary. Deficits are exploding. Spending is not being curtailed. And the political will to make hard choices simply does not exist. The Federal Reserve, regardless of what officials say publicly, is going to be highly accommodative. An early indication of what is coming appeared this week with Fannie Mae and Freddie Mac. The administration is now ordering these government-sponsored enterprises to purchase $200 billion worth of mortgage-backed securities. The stated goal is to use government intervention to reduce mortgage rates. But what it actually represents is a form of quantitative easing conducted through the GSEs rather than directly through the Federal Reserve. If this is happening now, before the economy officially enters recession, imagine what will happen when the downturn becomes undeniable. The liquidity taps will open completely, and precious metals will respond exactly as they always do when monetary policy becomes extremely loose. Central banks will buy more gold this year than they bought last year. Not just the central banks that have already been accumulating aggressively, but other central banks who stood on the sidelines. They watched while other nations increased their gold reserves. Now they are going to buy. They are going to fear missing out on the opportunity to secure gold at current prices, because they understand that gold needs to be part of their reserve structure. Last year marked a historic milestone. Gold replaced treasuries as the largest reserve asset held by central banks globally. This was not a temporary shift. This was a fundamental change in how central banks view reserve allocation. And this trend is going to continue for many years. It represents massive and sustained demand for gold that will underpin prices regardless of short-term fluctuations. But central bank buying is only part of the story. Individual investors are about to enter the market in force. They were largely absent last year. Retail participation was minimal. Institutional money mostly stayed away. But that is changing. This is going to be the year that Wall Street wakes up and discovers precious metals. Fund managers will start allocating capital to gold, silver, and mining stocks. Financial advisors will begin recommending exposure to clients, and the wave of capital flowing into the sector will be substantial. The Trump administration's foreign policy, particularly regarding tariffs and trade relationships, is creating uncertainty. The economic policies being implemented are creating conditions that historically precede major currency crises. The deficit is skyrocketing. Trade wars are intensifying. And the underlying fragility of the financial system is becoming more apparent with each passing month. What is happening now is exactly what Schiff has been forecasting for years. The real crash is coming, not the type of correction that markets experience periodically, but a fundamental restructuring of the global monetary system. He wrote about this in his book published back in 2013, titled The Real Crash: America's Coming Bankruptcy. The crisis just took much longer to arrive than he initially expected. After the 2008 financial crisis, when the Federal Reserve launched quantitative easing, Schiff anticipated that a dollar crisis would follow relatively quickly. But it did not happen. The system proved more resilient than expected. Central banks coordinated their policies, and the crisis was delayed. But delayed does not mean canceled. It simply means the imbalances grew larger, and when the crisis finally arrives, it will be far more severe. This is the dollar crisis. This is the sovereign debt crisis that has been building for over a decade. The situation now mirrors 2007 in disturbing ways. The economy is on the verge of another major crisis. But this time, the crisis will lead to dollar destruction and a collapse in the bond market. The fact that it did not happen earlier means the eventual unraveling will be even more catastrophic. The parallels to 2007 are striking. Schiff recently watched a segment on Larry Kudlow's show where the host described the current economy as the greatest story never told about the booming Trump economy. Those exact same words were used to describe the George W. Bush economy in 2007. Back then, everyone except a few voices, like Schiff, were celebrating how strong the economy appeared. But Schiff was warning that it was a massive bubble. He explained on television programs that the housing market was unsustainable, that subprime mortgages would collapse, that a financial crisis was inevitable. Republican guests dismissed these warnings. The mainstream financial media ignored the red flags. And when the crisis hit, it devastated the economy. The same dynamic is playing out again. Republicans think everything is wonderful because there is a Republican in the White House. The financial media celebrates record stock market highs, and anyone raising concerns is dismissed as a pessimist. But the economy is actually in worse shape now than it was under Bush. The mistakes being made are bigger, and the eventual correction will be more painful. The official statistics do not reflect reality. If the economy were truly strong, the dollar would not be this weak. Gold would not be at record highs. The deficits would not be exploding. A strong economy generates tax revenue. It reduces government borrowing needs. It strengthens the currency. None of that is happening. Consumer confidence is at record lows. Presidential approval ratings on economic issues are near historic lows. People understand that the economy is not performing well, even if the media refuses to acknowledge it. The disconnect is not between voters and reality. The disconnect is between official government statistics and what people experience in their daily lives. Trump understood this as a candidate. He correctly identified that government economic data was unreliable. He called the numbers fake. He promised to expose the truth. But now, as president, he hides behind those same statistics to claim the economy is booming. The numbers he once called fraudulent are now being used to justify his economic policies. One of the primary indicators being cited is the stock market. The S&P 500, the Dow Jones Industrial Average, and the Russell 2000 all hit new record highs recently. The Dow is approaching 50,000, and politicians point to these numbers as proof of economic strength. But when measured in real money, in gold and silver, the stock market has gone down significantly. The Dow was at 10,000 25 years ago. Gold was under $300. Silver was under $5. Yes, in dollar terms, the Dow has increased. But in terms of purchasing power, in terms of real wealth, stocks have lost ground to precious metals. This is why politicians love inflation. They can claim the economy is growing even as citizens become poorer. It is easy to make nominal asset prices rise when the currency itself is being debased. But the illusion cannot last forever.